From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. Right now, we are looking at sleepy markets, although turning down as we head closer to the open. The countdown to that open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
We begin with the big issue, the holiday shopping season kicking off.
Black Friday.
Black Friday.
This is a Black Friday like no other.
There's definitely good interest.
I'm really optimistic.
I do think it's going to pull forward sales from Christmas.
We saw the early start to holiday.
Consumers have delivered this year.
This is an interesting year.
Consumer sentiment is at a record low.
We have had a very steady pace in terms of overall spending, and the labor market is great.
There's still a lot of pent-up savings. There's still a lot of liquidity in bank accounts.
People, when they have income, they spend it. Americans have income.
Most retailers expect it to be a sort of subdued holiday season, not a disaster, but a more promotional holiday season.
And honestly, I'm not too worried about some of these businesses, the big businesses, taking a little bit less in profit.
A fascinating moment. Joining us now to discuss Aberdeen's Luke Hickmore and Peter Chatwell of Mizuho. Both of you, thank you so much for being with me. Luke, I want to start with you. We heard all that optimism about the consumer and how much they're spending. You push back. Why?
I think the consumer is kind of struggling a bit in the US. If you look at the rise in unsecured debt, in particular credit card debt, really since January, February this year, it's been extraordinary. And it points to me that the real bit of the consumer that's spending, those on the middle and lower income cohorts, are running out of those savings if they haven't run out of them already. So discounts are going to have to be heavy to get them to borrow more. I think the December and January borrowing stats are going to be some of the most important economic stats we're going to see for months and months and months.
Meanwhile, Peter, do you agree with that, this idea that potentially we're seeing the last gasp of the consumer?
Last gasp, I don't know. I think it has surprised a number of observers just how resilient the consumption has been. And if it has been simply extending credit lines to do it, then it makes a lot of sense. But a thing I would add to what Lucas said is that it was actually the surprise resilience on the consumption and generally the US economic momentum, which has meant the US is likely still not in recession yet. And that, in my mind, is really important when it comes to analysing just how far the neutral interest rate in the US may have risen.
Well, Peter, let's build on that. This question of we might not be at a recession yet. What will be the telltale sign for you that we are indeed in recession, that we're starting to see the pain in force coming through?
Well, I think if you look at the US economy from quite a global perspective, I think most people would be very surprised, most models would be very surprised as well, that after such a period of volatility and a massive rise in interest rates and also profound dollar strength, still the consumer is still going. Most sectors in the economy are still not yet in contraction. And that, I think, for the scale of the monetary tightening that's already been delivered, is something of a surprise. And that, to me, suggests that next year, when economists and when the Fed is assessing the appropriate level of monetary policy for the neutral setting and where they may be setting policy over the medium term in future years, I think they'll probably assess that this drift lower in the neutral rate, R star down to 0, has reversed, and now we've got a phenomenon of R star actually rising up significantly above where it has been over the last decade.
Well, the latest Fed minutes signaling that recession could be shifting into the Fed's base case, reading, quote, the staff continued to judge that the risks to the baseline projection for real activity were skewed to the downside and viewed the possibility that the economy would enter a recession sometime over the next year is almost as likely as the baseline. Luke, this is part of what's underpinning, I believe, your view that we're going to get to that terminal rate maybe and stay there for perhaps a little bit, but not the protracted period that people think. Please explain.
Yeah, I think that's part of it. And I keep trying to remind myself, I suppose, that everything's happening in this business cycle at a very, very, very quick pace. We've gone into it quickly, part of the invasion in February in Ukraine. Inflation took off at warp speed. Interest rate rises have been very, 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 very quick, and will probably be that way for the next few months. I think to think that it doesn't end quickly and come off the other side quickly just seems a bit disingenuous, really. And I think a lot of that may well be around, as they say, if you look at where the income brackets are, how well they're feeling about life, how they're spending their money, and they are actually finding it pretty tough now. So, yeah, not in recession yet. I think we will be getting into a recession quite early next year. It's going to feel different because nominal growth is going to feel fine for companies for some time. But for real growth, it's going to be tough. And real wages, that's the thing. That's what, for me, really pushes us into difficult times early next year.
And this is the reason why a lot of retailers are expecting a pretty muted holiday season, perhaps the first real sales decline when you strip out inflation going back to 2009. You've seen that inventory buildup forcing companies into widespread markdowns, which could mean a hit to profits. For more, joining us now, Bloomberg's Kriti Gupta at Manhattan's Herald Square. What do you see out there, Kriti?
Well, look, you hit it right on the head. The idea of an inventory buildup is really crucial. 33% year over year, Lisa, and yet there's kind of a fine balancing act between a lot of retailers. Sure, inside Macy's right now, the shelves are stocked. The racks are still fully stocked with brand new merchandise. The trick is they have to get rid of it, even as consumers actually spend more than they were expected to pre-pandemic, to the tune of 2.5% year over year spending growth. Lisa, the tricky part here is simply the fact that you are seeing extremely high promotions, extremely high markdowns. But at the end of the day, is it going to be so much promotional excess to the fact that they get rid of the inventories, but then at the end of the day, not make as much money and then ultimately lose on their balance sheet? That seems to be the balancing act right now for a lot of the retailers, Macy's included.
Kriti, what's the traffic like out there?
You know, it is not the trampling or long lines that I was expecting. In fact, it's actually all pretty calm. A lot of the folks here are just looking at simply the merchandise and then choosing to actually shop back online. They don't want to carry the bags. They don't want to necessarily shop in person as they used to. But I should say at 5:30 this morning, there was a line around the block, Lisa. Perhaps not the kind you saw 5 years ago, but still people really loving the in-person experience.
Kriti, thank you so much. Have fun. And Luke Hickmore and Peter Chatwell are still with us. I do wonder, Luke, given the fact that people are out there, that people are discussing this, and given that Peter believes that inflation is going to remain higher for longer, that higher are starred, where does a recession leave us when it comes to bringing down how quickly prices are going up?
Yeah, so we need both the recession and higher unemployment to really get inflation down. And in that sense, I guess I agree with Peter to a degree. I do think inflation is going to come down next year, and we're probably looking at 2% lower per quarter as we go through the year to the end of the year in the 3-ish kind of area, I guess, which I'm guessing is going to be way below what Peter's thinking. And it's what supports my 4.5% peak in the first quarter, maybe first half of next year, rather than getting to the market's 5% kind of number. And it's going to take a few things to get there. I fully accept that. I could easily be wrong. It's basic. We've all been wrong on inflation for the last 2 years. But it is hard to keep these numbers going year over year over year over year over year. I think we do slow, as I say, 2% a quarter.
So, Peter, how do you push back against that, saying that, yes, the comps are hard in order to keep posting these kinds of numbers, but if we get down to a 4% inflation rate or a 3% inflation rate, it's vastly different than struggling to get to 2. How do you sort of frame out the drivers of inflation that will keep that R-star higher?
Yeah, I think that it's once that 4% inflation rate is analysed and it's the strength in the underlying inflation that's still showing itself to be prevalent. You know, a lot of the goods prices through massive base effects will be much lower, if not in deflation. But underlying inflation, I suspect is still going to be very strong. And Luke talked about the labour market. That's absolutely important. I don't see many factors other than a much deeper than expected recession that is going to get unemployment up to a level where it is no longer posing structural upside risks to inflation. So I think it's almost a tautology that unless we have a super deep, much worse than expected recession, I don't see the inflation risks going. Geopolitically, I assume the situation is going to remain unchanged from as it is now. And I think the domestic political agenda for most major economies is still going to support a reshoring of productive capacity. Therefore, economies are going to have greater levels of friction on a structural basis. We're going away from globalization, not reverting back to it.
Well, but that really leaves a question, Luke, when it comes to margins, that essentially if consumers are getting really compressed when it comes to their real wages going down, and at the same time you see this persistent inflationary push, how much do you see margins ultimately take the hit, and do you not want to be in certain equities?
Well, Lisa, I think margins are going to be absolutely key for all of us next year. Generally going to be all right, I think, for most of 2023, but the kind of wage settlements we're seeing coming through now, even with the lower inflation, whatever that outturn ends up being, those wage settlements are going to be higher for the next 2-3 years as they catch up on real wage growth. So, yeah, margins are going to be tough this Christmas for a lot of retailers. They're going to be tough right the way through next year for pretty much every section of the economy. But you wait. When we get into 2024, margins are going to come under a lot of pressure, and we could be looking at some quite severe cutbacks on people's projections for EPS 24 out through 2025. And 23 is already seeing cutbacks on people's EPS projections. So, I don't think equity markets have finished with this current inflationary pulse and what happens after it. I just mind your eye that this rally doesn't feel like it's got legs for much longer.
Luke Hickmore, Peter Chatwell, both of you are sticking with us, and we will continue this conversation. Coming up, EU trade ministers gathering in Brussels to tackle a host of issues.
We must assess our dependencies on other authoritarian regimes, not least China. We must manage the risks, reduce our vulnerabilities, and increase our resilience.
That conversation up next with European Trade Commissioner Valdis Dombrovskis. From New York, this is Bloomberg.
We need a decent compromise. If we agree on some kind of price cap that doesn't threaten the security of supply, I think a very strong message for the market in terms of decarbonizing gas in general. Keeping unity in this situation is paramount. We cannot let Russia divide us on energy.
EU trade ministers wrapping up a meeting to address a host of issues, including U.S. trade relations and the Inflation Reduction Act. Joining us now with one of the most important interviews of the week, Bloomberg's Maria Tadeo in Brussels with European Trade Commissioner Valdis Dombrovskis. Maria.
Yes, thank you so much. And we are joined here from Brussels by the Executive Vice President of the European Commission, but also handles the trade portfolio. This is one of the biggest issues today. And of course, the focus point is on the Inflation Reduction Act. What is going on between the European Union and the United States? And are we heading ultimately to a trade war?
Well, we just had those discussions among EU trade ministers, so EU-US trade relationships, also in the context of upcoming Trade and Technology Council, which is going to take place in Maryland on 5th of December. So there are many avenues how we are deepening our cooperation in trade area, but at the same time, there are major concerns concerning this Inflation Reduction Act and the discriminatory provisions against EU companies across the whole range of areas, electrical cars, batteries, renewables, energy-intensive industries. So currently we have a joint EU-US high-level task force, which is working on this and hopefully producing the results. I would say the message from the ministers was very clear, that we need to see concrete results and we need to see the EU concerns addressed.
And you've talked about concerns now. You also said discrimination, potentially. The concern is that Europe is not going to get a good deal out of this. But I wonder, in the talks that you have already with the Biden administration, do they listen? Do they understand the problem? Because the Germans say potentially the issue here is that they just don't understand the concerns. It's not they want to fight a trade war. They just don't understand the problems for us.
What we are asking is basically fairness. We want European companies and European exports to be treated the same way in US as US companies and US exports are being treated in the EU. So that's what we are asking. To give a concrete example, for example, electrical vehicles. We are also providing subsidies in EU for electrical vehicles, but we are doing it in a non-discriminatory way. So also, for example, European consumers can buy Tesla made in US and get the subsidy. And actually there are consequences. For example, in September, the most sold model of the car in Germany was Tesla Model Y. So in a sense, we want to have the same non-discriminatory treatment also in case of US subsidies.
And can I ask you, you talk about the talks, of course you referred to Tesla, I guess you want to see German cars also, not just German, but Europeans also being sold in the United States. When do you expect the Biden administration to say, okay, we hear you, we can fix this? And the question is, if they don't, do you foresee that ultimately we're going to go back to a replay of the Trump administration with tariffs going both ways? EU and US share a strategic partnership, and I would say it's especially important in current geopolitical context when we are dealing with Russia's aggression against Ukraine. So it's important that we are cooperating and we are united, and that's indeed why it's so important that this Inflation Reduction Act is being addressed and it doesn't become another irritant in our relations. And of course, you mentioned the context of the war here. This week, we've seen a lot of talks, but not a lot of actions on things like the price cap. Again, some of the tensions between the different member states in the European Union. Will this unity hold, especially as the winter gets tough for Europeans in the face of Russia?
Europe has responded in a united and strong way. So far, we had come forward with 8 packages of sanctions against Russia. We had provided substantial support to Ukraine. We are determined to continue so. Currently, indeed, there are discussions on price cap on Russian oil. I would say it's not only among the EU, but because we need to agree it at a G7 level, because it's a G7 price cap. So, yes, there are discussions. There are countries which are insisting on a smaller price cap, because it's true. If you put price cap too high, it's not really, it doesn't really bite, because actually oil is the biggest source of revenue for Russian budget. So it's very important to get this right so that it has really impact on Russia's possibilities to finance this war.
And some say ultimately Vladimir Putin, with this cap or no cap, he's still making money. In your view, and of course you come from a Baltic country, should the European Union, the West, to increase the pressure further? You have to break the Russian economy, and that means the energy.
Indeed, I think we need to continue to put pressure on Russia as long as aggression continues. So now the next practical step is indeed this price cap, and it's important to get it right, to find the right level that really bites.
Mr. Dombrovskis, I know you were in Ukraine last week. Before we get into the help from Ukraine on the European side, I wonder if you could describe the situation there, because we get reports that the country is now very cold. There's no water, there's no electricity. This is happening in 2022. For many, it's incredible that you have a country that's gone blackout. When you were there, what was the situation like?
Indeed, I was in Kiev last week, and the situation is very serious because Russia is deliberately targeting Ukraine's civilian infrastructure. So there are problems with access of heating, electricity, water. So they are really aiming for humanitarian catastrophe because it's getting cold. Winter is starting. There was already snow in Kiev last week. So also from that point of view, it's important we provide Ukraine with necessary air defense systems so that they can protect their critical infrastructure and ensure minimum functioning of all those key utilities.
And of course, you have been outspoken about Russia and some of the threats that it poses. The idea now for some is that Russia on the battlefield cannot win. It will not sustain occupation of Ukraine. So what they want to do is break the spirit of Ukrainians by making their life hell. Based on your knowledge of Ukraine, your conversations with the Ukrainian government, is that going to happen, or will these people say, we'd rather freeze, but we want nothing to do with Russia?
Well, there is a very strong determination in Ukraine. We also saw it in Kiev, that people are really ready to resist, but we need to provide them with necessary support.
And just as a final question, especially now we have our international audience, European, American also, but a global audience that at times finds it difficult to figure out what's going on in the situation. Once again, why is it important in your view that Ukraine ultimately emerges victorious for this? What are the consequences if Ukraine fails and Russia prevails?
Indeed, it's not only a conflict between Russia and Ukraine. It's really Russia is not hiding it, that it's in a imperialist mood, that it's going to invade other countries. So the conflict is going to spread. So it's important to stop this Russia's aggression, to stop the spreading of the war. So in a sense, it's not Russia against Ukraine, it's autocracy against democracy. It's about entire European security architecture and with repercussions across the world.
Mr. Dombrovskis, thank you so much. As always, appreciated your time on Bloomberg TV. And of course, Lisa, that was Valdis Dombrovskis, Executive Vice President for the European Commission, also handles trade. And again, he's making a very important point. The situation on the ground and in Ukraine, we talk about people that do not have heat and that do not have electricity, do not have water in 2022. Almost incredible scenes in the heart of Europe.
Yeah, heartbreaking. Maria Tadeo, wonderful work. Thank you so much in Brussels with European Trade Commissioner Valdis Dombrovskis. Coming up, the morning calls, and later, Allsprings and Mileti seeing opportunities amid continuing volatility. That conversation still ahead. This is Bloomberg Markets, The Open. Time now to look for the morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, Argus cutting its price target on Lyft to $17 from $41, citing concerns about the recent sell-off following a round of layoffs. Next up, UBS cutting Man Group to neutral, analysts warning of a potential impact from an upcoming pension fund de-risking process. And finally, Credit Suisse raising its price target on Deere to a street high of $582, following a strong earnings beat and positive outlook. Coming up, The Open. This is Bloomberg. This is Countdown to the Open. I'm Lisa Rawins in for Jonathan Ferro. Moments away from the start of trading, if anyone's actually trading, because right now things are pretty much stasis, perhaps stasis to the downside. The Nasdaq down about 0.5%. You've got the S&P lower by about 0.1%. It's been a bit of a reversal, but let's not make anything serious about this because it is a quiet day. If you want to take a look at the yield space, perhaps this is the story behind the Nasdaq. You are seeing yields marginally higher, 3.73% on that 10-year after an incredible retracement, a rethink of how high yields could go over the past couple of days. Crude's higher, $78.34 on the NYMEX, and the euro-dollar pretty much range bound, but you are seeing a bit of dollar weakness, dollar strength, a bit of euro weakness, 103.63. It is one of the busiest days of the year for retailers. Companies bracing for Black Friday in the face of higher inflation and souring consumer sentiment. This coming as thousands of Amazon workers prepare to take part in protests and walkouts across 40 countries. What do the campaign's organizers say saying, quote, "It's time for the tech giant to cease their awful, unsafe practices, immediately respect the law, and negotiate with the workers who want to make their jobs better." For more, Bloomberg's Ed Ludlow joining us from LA. What's the latest, Ed?
Yeah, good morning, Lisa. I hope you had a good Thanksgiving. Interesting about Amazon is how widespread the action is. 40 countries are expected to see Amazon workers strike or protest. This is a globally coordinated initiative between a number of unions, interestingly led by unions out of Europe. Such a big story for Amazon in 2022, especially here in the United States, the traction that the union movement has had amongst its workforce at a time where some of the third-party data tells us that this Black Friday in particular could be a little softer for Amazon in this key holiday shopping season. One reason being that they held an earlier Prime event in October, which brought some pull forward in consumer spending. The other really big tech story we're watching is Twitter. According to sources in Brussels, Lisa, the remaining staff, just a handful of them, are now gone from that office. But this is critically important because, of course, Twitter faces regulatory questions around the world, but in the European Union in particular, when Musk closed his deal to buy the social media platform on October 28th, it was members of the European Union's leadership who were most vocal about saying that Musk and Twitter had to, quote, fly by the EU's rules. So, you know, it's interesting they do not currently have staff there dealing with these policy issues. And I think Musk tweeted just overnight that they are going to go ahead with the verification launch next week. And he gave some explanation as to how they'll do that. But a lot of content moderation questions right now for Twitter.
Ed Ludlow, thank you so much. Luke Kawa of UBS has been betting on cyclicals. We caught up with him earlier this morning. Take a listen.
Where we do see kind of room for more progress in environment is value cyclicals relative to defensives in particular, relative to kind of more high growth tech stocks, and you'll see a lot of scope for continued gains there. And this is just when you're kind of pricing in the degree of pessimism you see now for 2023, then anything that's better than that looks like a very good news story on the cyclical front.
Back with us, I'm so pleased to say, Aberdeen's Luke Hickmore, and also joining us, Allspring's Anne Maletti. And we were speaking earlier with Luke, and I want to get to him on this in a second, about how some of these margin compression issues are going to become more acute heading into next year, especially in the retail sector, as we just heard, places even like Amazon dealing with worker pushback in the face of inflationary pressures for them as well. How is that affecting your view of the consumer discretionaries, the cyclicals that a lot of people are saying could look good?
You know, I do think our investment teams are a little bit more positive, I would say, on the cyclical areas, but not so much the e-commerce consumer discretionary areas. And I think it's because of the extreme growth we saw. If you look at Q4 2020, for example, the growth that we saw in e-commerce in that quarter was the equivalent of the growth that we saw over the past 17 prior quarters. So 450 basis points of growth in one quarter. And that was obviously a big pull through, obviously COVID related, but now it's just normalizing. And, you know, if we're headed into a recession, will we see more compression instead of just normalization? That's kind of a reason why we're seeing some of the challenges at the online retailers, I think.
Luke, do you see a distinction between online and in-store? Do you see some sort of differentiation, or do you think that this is going to be a wholesale reset when it comes to earnings per share based on some of these conflicting issues of inflation plus workers demanding higher wages?
So 2020, 2021 were massive years for online sales growth. And I think it brought forward growth of online shopping by 5-10 years in terms of its penetration of total retail spend. So yes, to a degree, but they're going to face exactly the same problems as the bricks and mortar retailers, getting those margins right, keeping their costs down, kind of driving forward rather than being held back by wages. I think that's no different now for online to as it is for bricks. So to some degree, yeah, they can have a good Black Friday. They'll have people hunting down deals like they were everywhere else. But But I also, the whole retail industry's got used to what the online does and how you respond to that sort of bricks and mortar side of things. So I don't know. Some of me feels it's a 2021 question.
Interesting. Basically, at this point, Amazon's like any other retailer, just has the cloud computing system that's going to also support it. Luke, from your perspective, if you are going to see this earning per share, this EPS compression heading into next year, which asset class, which region of the equity market do you think has least priced that in?
I still think you've got to be chasing income equity. Maybe that's because I'm a bond guy, a credit investor, and that's really what I'm all about. But I think if you can get decent quality balance sheet, protectable margins, good track record on dividends, and keeping them high, that's the kind of way you survive these kind of equity moves and tougher and tougher EPS projections as we go through 2023. So probably value for me over growth.
And from your perspective, how much are you looking at bond substitutes or things that can generate income at a time when yield is once again a thing?
I do think income is going to play a role here, both in the fixed income market, but also in the equity market as well. We are seeing investors who are looking for more equities where you can find, excuse me, dividends as well. But I wouldn't discount equities totally. We are seeing broad-based multiple compression that happened. We do need to see more earnings be taken down, right? We have not seen that. We just started to see it this quarter. We need to see more earnings just get more into check here. But if you're an investor and not a trader, there are a lot of opportunities in the marketplace. What we're expecting, though, is for fundamentals really to matter going forward. It's going to be a recovery that companies are going to have to earn. You're not going to get the V-shaped recovery that some may be expecting from policy or the Fed. It's going to be ones that are going to be organic, that companies are going to need to see some growth, whether it's a value company seeing very modest growth or a growth company generating some top line growth, but they're going to need to earn that growth, and it's not going to be given to them.
Meanwhile, I do wonder, Luke, from your perspective, you believe that the Fed is going to start cutting rates next year. And from the credit's perspective, do you think that that's going to be a complete boon? That basically we're seeing the recession right now. The Fed's going to pivot really early and then cut rates. And then all of a sudden you get credit outperforming and having the best year of decades.
Possibly. I think it depends which credit market. I like EU, I like GBP. US feels for me that it's got a little bit of lifting to do in terms of where it is and where it should be priced for the problems coming down the road. I mean, as you've been discussing all afternoon, a lot of people thinking we just avoid a US recession. That's not where I am. I think we do get a recession in the US, in which case US IG is not priced yet. But I think there is really good value. And with Anne, I completely agree. Credit, much like equity, there are opportunities all over the place. Dispersion has got massively higher over the last few months. As an active investor, that's just great.
Meanwhile, Michael Hartnett, Bank of America's strategist out there, highlighted that the largest inflow into bonds in the past 15 weeks. That's what we've seen. Long bonds H1. We stay bearish risk assets in H1, set to turn bullish H2 as narrative shifts from inflation and rate shocks of 2022 to recession and credit shocks in H1 of 2023. When you go macro, and Meletti, when you take a look at the bigger picture, where do you agree with this and where do you push back?
Well, I do think that we are really, from a macro standpoint, our investment teams do believe that things are going to get a little bit tougher here, that the Fed is pretty serious. But we do also think that they will pause when it comes time to actually seeing that the work they've already done has taken hold. They will pause. But we don't think, again, that they're going to give us those rate cuts immediately. And that's why I said companies are really going to have to earn the right to go up. The stocks will go up, the ones that deserve it, but not all of them. And that does present a lot of opportunity for active managers. And so I think we're really, really well positioned from that standpoint.
Anne Maletti, you'll be sticking with us. Luke Hickmore, thank you so much for being with us and have a wonderful weekend. Back with us with a look at the stocks moving at the opening bell. Here's Ed Ludlow. Ed.
Yeah, taking a look at Apple, interesting that it's now under pressure following the protests in Zhengzhou earlier this week. The principal site of its iPhone 14 and iPhone 14 Pro production now down 2% after a Reuters report overnight that production would be impacted to the tune of 30% in the quarter. Also seeing shares of Activision Blizzard down 3.5%. A report from Politico that there is consideration from the FTC to make an intervention in Microsoft's deal to buy Activision Blizzard that could come as soon as next month. The stock reacting to that. Schlumberger had been higher actually, but now down 0.6%. Generally, we saw energy and oil stocks push higher as Brent and WTI edged higher. And really interesting on this one, Lisa, Manchester United continuing its surge up 11.8%, 12% after comments from Prince Abdulaziz bin Turki Al Faisal to the BBC that the Saudi Arabian government would support any private Saudi bid to buy that company. Of course, we learned this week that Manchester United's owners, the minority stake owners, the Glazers, are considering all financial options for the club, including selling that minority stake.
Ed Ludlow, thank you so much and have a wonderful weekend. If I don't speak to you before then, coming up, a record number of COVID cases clouding China's reopening path.
I think the end game is that China will probably, by second half of next year, accelerate with regards to growth helped by the reopening. But the path to that could be incredibly bumpy.
That conversation coming up next. From New York, this is Bloomberg.
I think the end game is that China will probably, by second half of next year, accelerate with regards to growth helped by the reopening. But the path to that could be incredibly bumpy. And the real reopening, we always thought would occur kind of around Q2. And as you see those cases go up, you could say that, the risk is definitely that it's being pushed further out.
It is certainly a bumpy ride right now over in China, with uncertainty looming over how quickly they can reopen, among another record number of cases reported. This as protests at a top iPhone manufacturing plant threatens to impact production by as much as 30%. Team coverage starting right now. Bloomberg's Deirdre Hipwell in London alongside Ed Ludlow in LA. Deirdre, from your vantage point, how quickly are we seeing the cases accelerate in China? How significant is the COVID issue?
The cases are really rising. I mean, they're at a record high, and this is really unusual for China because this is a country that has restricted personal freedoms and really locked down its citizens. So what they're trying to do now is trying to ease restrictions, but at the same time contain the cases. And it's causing a lot of widespread confusion, which is what we're seeing, with the situation at Foxconn and what's happening in Beijing. It's a really difficult tightrope.
Meanwhile, we are seeing, Ed, the impact on U.S. businesses that do a lot of their manufacturing in China, in particular Apple. What has the guidance been out of Apple trying to gauge out the damage from the uprisings at their Foxconn factory?
Yeah, we're talking about the Zhengzhou facility, right, which is operated by Foxconn, a contract manufacturer. It's important because it accounts for 4 out of every 5 iPhone 14s that are made, particularly the iPhone 14 Pro. We had protests earlier in the week. The official line from Foxconn was that those protests were quickly brought to order and that the facility was operating normally. But you had the Reuters report overnight that this would have an ongoing impact, which would reduce production by around 30% in this current period, in this quarter. Beyond that, there are some longer-term issues here, right, which the protests came as a consequence of what are very tight COVID zero curbs. You saw authorities in Zhengzhou extend those restrictions to 8 districts in the city. And now you're wondering how the Chinese government in particular balances the control of this virus with the economy. And of course, the big news overnight, the RRR cut. In other words, China's central bank, the PBOC, basically reducing the requirement on lenders in terms of the amount of cash they have to hold in reserve, some form of easing. But the situation is still complicated as it relates to global supply chains, and Apple is a pretty good barometer, right, of the impact this is having on what is a central region when it comes to tech production.
Ed Ludlow, Deirdre Hipwell, both of you, thank you so much. Anne Maletti back with us. And Anne, I really do want to focus on the tech sector and how much of some of the disruptions over in China, both from the production standpoint as well as the demand standpoint, have impacted your forecasts for some of the tech giants. Have you really factored this in or started to reset how much you have to consider it heading into next year for the likes of Apple?
You know, this is something that we've been speaking to our emerging market managers about a lot, and more so not just for the emerging markets, but obviously the impact that it can have across all of the strategies that we manage at Allspring. And the interesting thing when we talk to them, you know, not that China is the US in any way, shape, or form, but if you think about some of the similarities that we had when we were emerging from the lockdowns we had, right, state by state, there were a lot of start and stops, a lot of changes to policy, a lot of confusion. And I think, you know, based on what we're hearing, and again, the information flow from China is not always crystal clear, but what we're hearing are a lot of similarities, a lot of challenges, a lot of confusion. And so I think I would expect to see that. I would expect to see a very bumpy road, a lot of, okay, we're going to do it this way, and now we need to make some adjustments. And so that will present some supply challenges, and it will, you know, potentially impact demand. But demand is challenged in the US because we are seeing the real impact of inflation here, right? So our investment teams are working to balance all of those issues. And in some ways, because there's less demand, we believe coming in 2023, maybe the supply challenges are less problematic than, you know, a year ago when we had really, really challenging demand.
So in other words, do you, just to sort of consolidate this down into your view in terms of pro or con buying some of the big tech names, do you see an opportunity here after the sell-off this year, or do you see that there are just too many issues pockmarking the landscape?
It's risk versus reward on every single individual name. And I think that's where you have to really be careful in a market like this, is to generalize too much. Because if you just say technology, if you just say semiconductors, if you just say big tech, you can miss really great opportunities. So for us, it's looking name by name and trying to find unique opportunities that might be getting thrown out because of generalization.
Anne Maletti, thank you so much for being with us. Have a wonderful holiday weekend. Let's right now head back to Ed Ludlow to get some sector price action this morning. Such an active morning, Ed. Parse through it and give us something to talk about.
Well, thin volumes after Thanksgiving, but let's go to IMAP Go on the Bloomberg terminal. And basically energy, kind of one of the most interesting sectors this morning, in large part because of reports that the European Union is seeking to boost the curbs on Russian crude. Higher oil means higher energy stock prices. Otherwise, we're very much focused, of course, on consumer and discretionary as we head into what is essential, a crucial part of the holiday shopping season, not just for names like Amazon, but legacy retailers as well. And you see some of that playing out across the equity sectors this morning. Lisa.
Ed, thank you so much. Indeed, it is quite an active day here as people reset with their tryptophanic trances. Coming up, the market moving events that you need to be watching. That's next in our trading diary. In the markets, wow, look at that. It's completely flat. 40, 26, 93 on the S&P. This is Bloomberg.